At the same time, there is a gradual slowdown. That's, if you look at it sequentially, there is a slowdown in growth. The US and the emerging markets ex-China, the growth has remained more or less resilient. If you look at India also, the growth remains quite resilient and good, while Europe and China have experienced a weak growth, and Chinese growth has been sub 5% all the time. So the growth has been affected. The actual and expected slowdown in the rate of economic growth. It is this slowdown in economic growth, or the sacrifice that has been done by monetary policy, or policy of hiking rates on a continuous basis, that has led to some give up of growth, and now the monetary policies are gradually being reshaped into taking care of growth. So there is the trade-off at this point of time is more poised in favor of growth rather than inflation, though inflation is also one of the factors which is going into the policy factors. And one very critical factor, which we may look at it slightly more detail later, is that we are going to have a new regime from January onwards in the US, with a person who has a very US-centric approach to things. So that could lead to some trade and tariff wars and competition and all that, which may also have some consequences for the price level as also growth. The geopolitical situation, whether it's Russia, Ukraine, or the Middle East, it still remains. There is some kind of semblance of calmness at this point of time, maybe because some negotiations are on. But those two critical situations in the geopolitical scenario, it remains very much there, and the continuing violence and war is of consequence to commodities prices. As far as India is concerned, because India has remained more or less neutral in this whole game, which means that has been a positive aspect of the foreign policy of India, and that has in the coming days will help India as far as its relationship with the entire community of nations is concerned, because we haven't taken any sides. Therefore, we are friends to all, and so that should work in our favor. As far as India is concerned, the growth outlook is excellent. The projected outlook for the current year has been around 7.20% by RBI estimates, but we ourselves believe that the growth will be around 7%, with 0.5% plus or minus, but structurally India is tuned to grow at 7%. So these are some of the macroeconomic factors, and this slide summarizes the global economy as far as the growth is concerned, from 3.3 to around 3.2 in 2025. Advanced economies also, the growth remaining more or less the same. And emerging markets also, there is some tapering off, but it is not very substantial. That's what this slide indicates in terms of the real GDP growth. When we look at the world economic projections, again, it shows that the world output is tapering off a little bit, but it's expected to not dip too much when it comes to the world output. When it comes to advanced economies, it shows for 24 there's a slight pickup which we see in some parts of Europe, and in 2025 it would still be maintained. When it comes to emerging market economies, there is still a tapering off of growth, but it doesn't dip too much so that we require some major changes in the policies, but an accommodative monetary policy is what's required. When it comes to the output projections, the manufacturing output, when we are looking at the manufacturing PMI, we see that the manufacturing PMI is also, we had seen a dip in 20, but thereafter it immediately picked up. But then it's maintaining a more or less even path at this point of time. And if you look at to the right side of the charts, you will see that India manufacturing PMI is at its highest level at this point of time. because manufacturing sector got some amount of push from government policies as well. If you look at the public capex for the last financial year was 10 lakh crores, and the public capex for the current financial year provision in the budget is 11.10 lakh crores. And that's the kind of money that's coming to manufacturing. That's the kind of orders which companies are getting, larger companies are getting, and from which downstream companies are also benefiting. Then we have the production linked incentive scheme. Therefore, manufacturing output is expanding at a very, very fast rate. The manufacturing exports, if you look at it in 2022, it was at around $280 billion worth of exports, and it has moved up to around 380 billion US dollars in 2023. So manufacturing, as far as India is concerned, is doing very well, and we expect it to continue to do well, though on account of maybe global factors and some of the domestic factors, it could maybe slow down a little bit, but it will keep up its pace all the time. When it comes to inflation, we have seen the inflation dipping substantially because the post-COVID time, the couple of years led to very high inflation and high price level. And thereafter, because of hard money policies or tight money policies, inflation has come down quite a bit. But in some of the countries, including the US and also in India, if you look at the prices of food prices, we will see there is some kind of a stickiness there. Food inflation picked up to around 10.87%, double digit. Now it has gone up to, as per the last consumer price index, the food index. So food prices, it's mainly because of seasonal factors. The prices of fruits and vegetables, especially of tomatoes and onions, these prices have moved up. That's getting reflected in the prices. But core inflation has almost all the time, core inflation has been below the RBI target rate of 4%. Core inflation in India is hovering around 3.4% at this point, 3.5% at this point of time. So that's one factor which must give us some comfort that ex food and fuel, it is behaving better, and that should also give some comfort to the policy makers that once the seasonalities go away and when this supply demand conditions become better, then things could be better. The Fed funds target rate, one of the key things that we should be looking at is that the Fed funds rate, which was at 0.20 to 0.25% in the US, it moved up to 5.25, 5.5% range. So it was almost a 5% rise in the rates in the US. It is a very, very high rate hike which the US had gone into, and it has started affecting growth. Therefore, there is all the reason why US rates could also gradually cut and rates could come down, because inflation has come down towards their long-term average rate of inflation, which they are targeting around 2%. So Fed funds rate with a 5% hike in the Fed funds rate is something that which needs to be bridged, which needs to come down to maybe around 4% or so. That is what we see in the Fed funds dot plot as well. Now, the most important thing which the whole world is looking at today, post the US presidential election, is that Mr. Trump is going to come back. And what were the things which distinguished him, or what were those unique things about him and his policies? Because his policies have always been US centric. So his approach is that of a businessman. He's transactional in nature and approach. Therefore, his approach would be one of US-centric policies which benefit the US, which means that therefore, even the next term, it will be US-centric. Second is that he has been following the mercantilist or the neo-mercantilist policies, which is a product of economic thinking, which is about 600, 700 years old, which lays stress on protecting the domestic economy. So he's going to follow neo-mercantilist policies, a US-centric policy, transactional in approach. And he has already said that there are statements attributed to him in which he has said that he would impose 25% tariffs and tax extra duties on Mexico and Canada and China. But he has spared India, at least for the time being. So we do not know what his approach would be, but he knows that India, it being a democratic country, and with a government in India with whom he can talk business and do work, yeah, we may be better received compared to many other countries. Therefore, we believe that his policies, especially in relation to trade and tariff war, which was more pronounced the last time against China rather than India, would again be the focus, and it will be more towards China, and containing any negative impacts the trade and tariffs would have for the US businesses is one of the things that he would be concerned with. Now, many people have been talking about it that if Trump comes in, there will be very high inflation and all that. High tariffs may have some impact if you are too much dependent on some imports. And there are some imports coming in despite very high tariffs. That may have a price impact, but that could be very limited. But if you are looking at the last 4 years of Trump, inflation was low, and in many items which constitute the price basket, inflation was in the negative zone. So therefore, if you're going by his last 4 years of Trump term, we can't say that Trump coming in could lead to high inflation and therefore high interest rates. It is unfounded based on data that is available to us at this point of time. It's also worth noting here that in the US, there have been the 30-year mortgage rate had moved up to 8%. And now it has come down to sub 7%, 670 or so. Now mortgage rate at 8% and a Fed funds rate of 5.25% is very high for an economy like the US economy, where inflation is relatively at a lower end. We in India are used to 7%, 8% for housing loans and all that. So there was a huge amount of exit of people from some of the housing localities and areas and premium locations where people found the affordability very difficult. So a lot of people moved from very premium and unaffordable locations to cheaper locations as far as housing is concerned. And in fact, that constituency of people is one of the sets of people who have voted for Trump at this point of time. Therefore, I think he would also focus on bringing interest rates lower, especially the mortgage rates, because the growth of the US economy and satisfying some of the basic needs like housing and affordability of housing is very much dependent on lower interest rates. During his last term as the president, he had asked the Federal Reserve Bank of New York to bring down the interest rates, to bring down the Fed funds rate. At least 4 times he had spoken in public asking the Fed to reduce the rates. So I think rate cuts. So these rate cuts, which are likely to happen in the US, but it may be graduated. It need not necessarily be coming 0.5% every time. It could be 0.25%. And moving towards maybe 4% over the next 3-4 quarters. But these, what is there for us in this is that usually when the Fed cuts interest rates too many times, 0.25% or 0.5%, whatever it is, when the Fed funds rate comes down and overall interest rates move lower, what happens is that there is funds in the US at this point of time, which has a natural tendency to chase high risk, high return assets in the emerging markets. We have seen outflows from emerging markets in the last couple of months, and it was a very, very large outflow from the emerging markets. But those outflows could gradually come down and could turn into inflows. We have so far seen inflows only into Taiwan and Japan, Japanese economy, because it's growing, and Taiwan could attract more funds because the antagonism between China and Taiwan could be much lower in the coming days because of Trump coming back to power. Therefore, once the rate cuts start gathering pace, or once it starts happening at a very systematic way, we believe that some of the funds from the US and other advanced economies could gradually move into emerging markets, especially India, and we expect growth to pick up gradually, both in the US and in India. In India, the rate forecast is 7.20%. The last quarter rate growth that we have got is 6.8%. We believe that Indian economy is structurally tuned to grow at around 7%, with a deviation of plus or minus 0.5% is something that we could expect, and that's normal. US growth also has been, if you are taking the last 4 months, for 3 months, the growth rate was sequentially lower. For the last quarter, the growth rate showed a slight uptick of about 20 basis points plus. Therefore, growth is intact, and it may gradually pick up because of more friendly monetary policy measures.
Can we move on to Ashish Ranade, please? Or Doctor, is there anything else you would like to add?
Ashish, do I continue with this? Shall I continue, Ashish?
Yeah, Doc, go ahead.
Thank you very much. Thanks. So coming to the domestic macro situation, the growth has slowed down 6.80% I had mentioned, but relatively much better from a global perspective. China is sub 5%, and the US, the last number was around 2.6%. So our growth is intact at this point of time. But the private and rural consumption has been slow. This may be because of 2-3 different factors. We had seen a very buoyant demand growth, if you're looking at automobiles or vehicles and things like that, has been in the urban and the semi-urban centers. It has been quite buoyant, and now we see gradually the inventory accumulating, and especially in the rural areas, the consumption has been slow because rural areas are highly sensitive to inflation and the higher price level, and because they make everyday calculations. Because of that, in the rural areas, the consumption, especially of food items or biscuits, packaged foods, or two-wheelers, there are a lot of things which are very closely associated with the rural consumption, and also private consumption has slowed down a little bit. In fact, it might probably require a cheaper credit to give a further push to the rural consumption. In fact, we had thought that once we have elections, the general elections and all that, the demand for beverages and snacks all would go up. But that hasn't actually happened. Government spending continues. There was a slackness in government spending, mainly before and after the elections, because that's how we are structured administratively and operationally. Now, the government will not take any new initiatives, and government will not spend much money, and there will be a slowdown in government expenditure, and that slowdown still continues. Everyone thought that post the election results and all that, it could pick up. We had seen some orders being placed by the government, but it was with far and few entities like Hindustan HAL or some other entities like an L&T or who got some of the orders and all that. So there has been a slowdown in government spending, but it's at the will of the government to enhance that spending. As far as monetary policy is concerned, RBI hasn't cut the rates as yet, but they have very cleverly put it into a neutral mode, which means that the neutral mode is something good for us, because that's a prelude to cutting interest rate, cutting the repo rate in the coming policy means. That is what we feel. So monetary policy is on a pause now. It is good for the economy that we have come out of the rate hike cycle, and we are now in a pause. And the trade deficit continues to be high, and it may continue to be high, mainly because in trade we have a major problem, because we continue to be major importers of oil and edible oil and gold and all that, and that will continue to be a feature, and trade deficit will continue to be high. And as you may observe, the rupee is also cheapening up gradually. The recent cheapening up has been mainly on account of FII exits and they taking the dollars out. The banking sector is in good health because of the much cleaner balance sheets. The problem of non-performing assets at its lowest ever. Probably that problem doesn't exist as such, but only in a very nominal way. Credit growth, which was at around the overall credit growth, which was at around 16 to 17%, has come down a little bit to around 13 to 14%. But one should keep in mind that 2 years back, 1.5 years or 2 years back, the credit growth, especially on the individual retail credit and all that, it was around 5 to 6%. And corporate credit was virtually nil. Tax collections have been very robust. Government had made a very realistic assumptions about tax collections. Anyway, the economy is growing at, is expected to grow at 7.20%, last quarter at 6.80%. We believe that the tax collections will continue to be robust, and we have seen the GST collections itself is quite buoyant, from around an average of around 1.40, 1.47 to around 1.80, 1.87 is the jump that has been seen. It's an indication of some kind of a buoyancy in tax collections. A real buoyancy would be if GST jumps to around 2.5 to 3 lakh crores. Growth is moderating after a strong rebound. That is, after 3 years, India's GDP is expected to soften to below 7%. We are already seeing that. I have mentioned that that it's at 6.8. We might see that, but we will maintain the range at around 6.5 to 7.5%. We can move that. We can move on to the next slide. The external situation, as we have seen, the trade balance or the trade deficit is it's continuing to be a reason. Though our reserves, forex reserves, at around $650 billion US, with changing dynamics of the economy has become quite large, and our imports have also become very large. Therefore, we have enough reserves to pay for 10 to 12 months of import payments. But the core import and core export trends report, they seem to converge. That's one of the factors we could take some comfort from as far as Brent is concerned, because we import oil. As far as the Brent is concerned, it has been in a very narrow range, something like $72 per barrel to around $75 per barrel level. In our analytics and all that, we had forecast the broad range to be around $75 to $80 per barrel, and we expect this to be maintained. If at all it was to go up too much, it should have happened because of Russia-Ukraine war and the Middle East situation. But it hasn't moved up much, mainly because of one or two factors. The first factor is that the US has become self-reliant in terms of oil, because the US daily production of crude oil has moved up to around 12.5 to 13 million barrels per day. This makes US more or less self-sufficient or self-reliant in terms of the oil requirements. The second thing is that the Chinese demand for oil, which the entire oil market looks at Chinese demand, because they used to demand, there was high retail and public demand for oil in China, which has come down. Actually, it has crumbled. Second thing is that the overall demand from China has also come down. Since 2023 November, oil demand has been coming down gradually. It could be because the economy is not doing well. An economy which was growing at 12% and an economy now growing at around 5% is two things. So there is low retail demand, low overall demand for building reserves. All these things have played their role in keeping oil prices at around the $74-75 per barrel level. We do not see any factor by which this price could move up to maybe 90 or 100 or even beyond that. Only if there is a very serious escalation of hostilities and war, this price could move up. Otherwise, it will stay within these ranges. Maybe $75 to $80 per barrel would define the upper ceiling for this. One of the things which could push up Brent is a very weak US dollar. If the US dollar weakens very much and depreciates very much against all the major currencies, then like in the case of any other commodity, Brent prices also could gradually move up. The likelihood of it becoming of Brent of US dollar depreciating too much is ruled out, because last time around, during the longest time of depreciation of the US dollar, the depreciation we had seen was around 32% against all the major currencies. But at this point of time, we might probably see something like 8 to 10% of depreciation, not more than that, because the economy is on a strong footing. Coming to the RBI policy expectations, because there are two, RBI has put the policy on a neutral mode. But there are two things which indicate to us that the RBI policy in effect is actually soft. Except for today and yesterday. Yesterday and today, we had a minor deficit in the interbank liquidity to the tune of about anything from 50,000 crores on an average. Prior to that, we had continuously had 2 to 2.5 lakh crores of interbank liquidity, which is surplus. RBI never drained it out of the system, nor did they do anything other than issuing government securities in the normal course of auctions. They had not done anything to withdraw liquidity out of the system. But the thing is that yet another thing. So plenty of liquidity in the interbank market, and RBI permitting is the first indication that RBI's approach is more soft, though it is in a neutral mode. The second thing is that RBI let the currency, the domestic currency, gradually slide from around 83.90, 84 to around 84.40 it is now. RBI was never too much worried about this slide, and it's now at around 84.40. It could move higher. 84.60 is a natural target for the dollar rupee. And what we feel is that this surplus liquidity in the interbank market and the rupee remaining relatively weaker are two indications that RBI in effect is promoting a soft policy. Otherwise, they would have drained the liquidity out and they would have intervened vigorously in the currency market to make rupee stronger. But irrespective of RBI cutting the repo rate is at 6.5% and it remains there. Despite the repo rate remaining at 6.5% and RBI taking no action, the market yields have come down drastically. Say, if you look at the 10-year benchmark, Government of India bond yield, it has slipped all the way from 7.80 to 760, 740, and today it's at around 685 to 690 levels. So it's about 100 basis points fall in the 10-year benchmark yield. And if you're looking at the short-term bills, like the 91-day treasury bills, or you look at the 1-year treasury bills, those rates have also come down by 50 to 70 basis points, which means that the market yields have been coming down, irrespective of what the RBI is doing. Therefore, we believe that the next trigger for the market, or what the market is expecting for the market to move, market yields to move lower, would be a rate cut from the RBI. Two factors help the fall in the benchmark yield and GSEC yields, as also the treasury bill yields, overall market. Despite RBI not cutting the rates, one is the index inclusion. You may be aware that JP Morgan Emerging Market Bond Index, the Bloomberg Bond Index, and also now the FTSE Russell Bond Index are all including Government of India bonds, and it has led to about 12 to 13 billion dollars of inflows in the last 6 months we have seen. There was some exit also, close to about 1 billion they sold and exited. But it was around, net must be around 10 to 12 billion dollars, which has come in because of index inclusion. Those monies came in and bought up the government securities, and that brought down the yields. As you may be aware, the government borrowing program for the current financial year is much lower. Last financial year, it was 15.5 lakh crores. For the current financial year, it's only 13.5 lakh crores, which means that the lower government borrowings means that the issue of government securities at the primary auctions will be much, much lower than what it was last year. That should also create a lot of demand for Government of India securities. Therefore, even without RBI doing anything with the 6.5% repo rate, the market yields have fallen. Sometimes we say that, we used to joke that RBI follows the market. Market falls and then RBI will start cutting the rates. Inflation, as you know, it's transient, because RBI policy cannot be based on these onion prices and tomato prices going up. And it has to be based on the requirements of growth and the demand for cheaper credit at this point of time, especially housing. Our housing and our housing mortgage rates are very high in India. It has to be cheapened up because housing is a priority sector for it. Unless you bring down the interest rate drastically and make it cheaper, and it's also something that will help the further development of the economy. And food inflation is seasonal, transient, and we believe that RBI will take cognizance of that. And maybe in the December policy or latest by the policy after that, there will be a cut in repo rate to the tune of about 0.25% to 0.5%. That's our inference from the factors that we are seeing and experiencing at this point of time, because market rates have already moved down. RBI policy rates need to align with the market rates and align itself to the requirements of domestic demand for growth and credit. I think, Ashish, over to you now.
Yeah, Doc. Thank you. So that's been the setting, both the global macro as well as the domestic macro. Last 4 years has been excellent for the Indian markets. We've had possibly the second best rally in terms of all the indices, and the rally has been more broad-based in the sense today we have more than 6,000 companies which are listed on both the BSE and NSE. And we've seen a significant amount of IPOs which have happened, which have also sucked in a good amount of liquidity which has been coming into the markets. In terms of, and when I say broad-based, what I mean is the rally is not restricted to only the top 100 names. Today, the top 100 companies account for around 60% of the total market cap of the NSE. Now, this figure I remember in 2008 was something like 87%. So that is the kind of value which the other companies have also added. They have grown in size. And today, the way the market has rallied, the mid caps have seen the maximum amount of growth in the last, since the classification of SEBI, the top 500 into large, mid, and small caps happened early in 2018. Now, also, sorry, next slide. Next slide. So one of the reasons for the markets to go up so significantly has clearly been a positive inflows from both the FIIs as well as the domestic investors. Yes, there has been some amount of volatility in terms of the FIIs when they look at India, because they have to look at India relative to the rest of the world. And we've had an episode in the last couple of months where certain policy actions in China drove a lot of research houses to upgrade China and downgrade India in terms of the emerging market allocations. But that's been reversed, and we are again seeing an inflow which is coming in towards India. But what remains astonishing is the number of or rather the amount of money which is coming into the markets from domestic investors. SIPs have crossed 25,000 crores on a monthly basis. And what this has done to the market is clearly, the market today is not in, it's not a cheap market to look at. Next slide, please. So if you see where we are in terms of valuations, and we've used the Nifty as a proxy, obviously the Nifty mid cap and the Nifty small cap indices are more expensive than what we have here. So if you see on the left hand side, the Nifty 1 year forward price earnings ratio is today at the high end of the valuation level. And especially when you look at the growth, because valuation is always looked at from a perspective of growth. So on the right hand side, if you see FY25, we are expecting a dip in terms of the Nifty EPS growth. We are expecting 7.9% on the Nifty EPS growth, which is way lower than 18.9% which we witnessed in the last financial year. And just to elaborate on that slide a little more, if you see the growth in FY23, it had come down significantly from FY22, which was 29%. And we did see a dip in the markets when that happened. So while, given that today we are at a situation where the markets are expensive, but there is a huge amount of liquidity which is coming in from both the domestic as well as overseas investors. Even if we may not dip, we may remain sideways for some amount of time till we start seeing growth return back to the earnings growth. Because end of the day, it's earnings growth which is what's going to drive the markets. Next slide. So from a wealth manager point of view, what do you do if the broader markets are looking expensive, the valuations are looking expensive? And as I said, I just gave an example of the Nifty. The Nifty small cap, the Nifty mid cap, and we also have a Nifty micro cap today. They are all looking very expensive from a pure valuation point of view. And even if you look at the Indian market from an overall perspective, the market cap to GDP ratio for India today, and market cap includes all companies put together, we are at a 15-year high. We are at almost 140% in terms of the Mcap to GDP ratio. And just to put things in perspective, the US today is at somewhere around 200%. And when you say, the US, it also includes a lot of companies which are listed there, which are not US centric. They cater to the rest of the world. They draw a large percentage of their revenues from overseas. So just to give an example, Apple, a large percentage of Apple's revenues come from outside the US. Although technically it is listed in the US, the market cap gets added to that of the overall US market cap. Also, there are many companies in the US which are global companies again, or which may be doing business in China or in Europe, but which are listed on the US exchanges. So when you look at that and look at this number of 200% market cap to GDP ratio for the US market as compared to that of 140% for the Indian market, it looks very expensive. So now, obvious question to a wealth manager is, what do you do in this kind of a situation where the Indian market is looking expensive? Now, the good thing is, unlike say in 2008, when we had the best rally in the Indian markets, I mean, just to put things in perspective, 2003 to 2008, the index rallied from 1,000 to 6,000, which is almost a 6 times growth in 5 years. Today, in the last 4 years, from the bottom of COVID till now, we've seen only something like 2.75x growth in the indices. And in that time, we had close to 2,000 companies which were listed on the Indian bourses. Today, we have close to 6,000 companies which are listed on the Indian bourses. So the breadth, or rather the width of opportunities in the Indian market is quite significant as compared to what the indices indicate, which basically gives me, or rather any fund manager, an opportunity to be very stock specific when building up the portfolio. And I feel that over the next 2 to 3 years, while the market's consolidating or the broader indices are consolidating, stock specific opportunities will remain. Even at this point in time, I can tell you 20 stocks which are not in the expensive zone at all and which will benefit from the tremendous amount of tailwinds which the Indian economy is experiencing, especially on the government spending side. So, given that, I feel, or rather we feel, that an active fund manager should do well. Today, the mutual fund industry, when you look at the industry as a whole and the kind of products which are coming out of the mutual fund industry, there is the compulsion to be benchmarked. Well, there are fund managers who are bucking that trend. So we would love them to, we would love to back them up. But broadly, if you see, it's the PMS and the AIF fund managers who have a much better ability to create portfolios which are different. And I would say investors should start looking at, some of these fund managers. They may be small and there is an advantage in there because they have the flexibility to pick the kind of stocks which they want, which ideally they want to have in their portfolio. So that's one area which I would look at if I was an investor. The second area which I would look at is overseas equity. And, again, let me bring you back to the US market. While the broader US market is expensive, it's more expensive because of the top 10 stocks which exist there. If you look at the old economy kind of stocks, they have fallen more than a large number of these stocks have fallen 50% or more in the last 1 year, or rather since the time the Fed has started increasing interest rates. Now, there are some very interesting funds in India, mutual funds, which invest in the overseas markets, which we have cherry picked for investors. And we believe that, with Trump coming in and with interest rates in the US headed down, some of these funds will do very well. And an investor needs one or two good funds. And, these funds are very diversified funds. They are FOFs, which basically mean Indian funds investing in overseas funds, which are $1 billion plus in terms of size. And, that can be a very good opportunity for investors to invest in equities. It also provides a good amount of diversification in a situation where the Indian market's looking expensive. So when you look at the portfolio P for these funds, it's much lower than what the portfolio P is for some of the Indian funds. So that's the second opportunity that exists. The third opportunity is in the unlisted space. There are many unlisted companies which are expecting to go IPO in the next 2 to 3 years. And many of them are available today in the market. Now, of course, you need a wealth manager, you need somebody to scan these companies and to be able to shortlist some of them, because there is a lot of riffraff out there. So you want somebody who's done some research or who is cherry picking these for you. But there is an opportunity there, because I think for the next 5 years, the Indian equity markets is going to remain buoyant. And there is a whole lot of, interesting things which are happening in India today. Very interesting sectors and segments which are upcoming, just like how defense was, or just like how, space was till some time back. And I think, there are these opportunities which can be looked at by investors. From a traditional point of view, we are in an interest rate cut cycle. So at some point in time, maybe 1 year, 1.5 years down the line, you will see the full benefit of that cycle play out. While Doc did mention that, it's going to take some more time as far as India is concerned. In the US, it's already started. But we are, hopeful that over the next 2 years, or let's say 1.5 years, the cycle will completely play out. So long duration is where one can start looking at in a systematic way. You will never be able to catch it exactly at the time from where it pivots. But if you start investing in a SIP kind of a manner in a long duration bond or long duration fund, it kind of would work out to your favor, in your favor. So that's from an asset allocation and a portfolio positioning point of view. We had given a call on gold some time back, and that's played out very well. Gold as an asset class has been, performing. I mean, I think there's a section on gold. If you could just take me there, Amit. Yeah. So if you look at the performance of gold over the last 3, 5, 10, and 20 years, gold returns have been on par with equities, especially on a 20-year period. And they've been above bonds since the end of the gold standard. So from that perspective, gold becomes a very interesting asset class because it has delivered good returns. At the same time, the volatility on gold, if you see in the next slide, and the correlation of gold with equities or with bonds, especially during a sell-off, it is very, very low. So gold is as an asset class is giving you good returns with very minimal downside. Next slide. So that's the kind of volatility which gold has compared to emerging market stocks or US stocks or crude oil or global stocks, or commodities for that matter. So, from a portfolio perspective, if you add gold to it, next slide, it gives you the advantage of returns. It gives you the advantage of diversification. It's a very liquid instrument. And at the same time, when you add gold to your portfolio, your overall portfolio risk goes down significantly. So from a portfolio performance point of view, the risk return is optimized when you add gold to your portfolio. So that's broadly, the setup in terms of a wealth customer or a wealth investor. There are many other options. There are many other ways in which an investor can invest today. For instance, an investor can open a US account, US trading account sitting in India, transfer money through LRS and buy direct equities or buy ETFs or the option of mutual funds from time to time. It kind of, there are some funds which are open for business, some which are not, depending on the overall limits which the RBI and SEBI has set. So you need to be very careful, and you need to be at times very aware of which fund is open for subscription and which fund is not. But if you're opening an account for investing overseas, then you're always free to, send money through LRS and buy whatever you would like. The safest to do is to buy an ETF. And there are many ETFs which are listed on the NYSE. So that's about, the overall perspective that we wanted to bring to you in terms of where we stand in terms of both the global macro, the domestic macro, what are the areas where an investor can look at today, especially given the fact that, Indian markets are looking expensive. And at Emkay Wealth, we always have, at any point in time, interesting products, interesting ideas, interesting stocks. We are a research house, so we also have a 40-member research team which is tracking 250 companies. Many of our clients are direct equity investors, so we also have the ability to give them research-based advice. Happy to take any questions.
Friends, you could raise your hands to so I can unmute you so you can ask your questions, or you could type it out in the Q&A feature. So the first question we have is from Prashant. Just a moment. Yeah, Prashant, please go ahead.
Hello, can you hear me?
Yes, Prashant.
Yeah, hi. You said, one could take allocation to the US. So just wanted to understand what percentage allocation of my equity portfolio could one take, and what schemes do you suggest?
See, it again depends on What kind of returns are you expecting? What kind of a portfolio characteristic you would want? So, for instance, I mean, if it is a balanced kind of an investor, then
Hmm.
you have a 50-50 in terms of equity and debt.
Hmm.
Then from that 50, you can possibly look at now if you're a very large cap, again, US market is very different in terms of technology. You have the best
Right.
of technology which is available there, which is not
Hmm.
available in India.
Hmm.
If you want to have a higher technology exposure, then you can
Hmm.
possibly look at a higher exposure in the US. Many of these companies are large cap, so if you want to have a large cap exposure, then you are a you will be trending more towards the US. But if you are somebody who is a very small cap or very high risk kind of an investor, then you would rather your best place to be in the Indian small caps or the Indian micro caps. So it depends on, so each investor is different, each investor's portfolio is different, each investor's portfolio allocation is different. But if you ask me in terms of for a very conservative kind of an investor, I would say at least a 30% of the equity portion should be in the US.
30% of the equity portion.
Yes.
Okay. Okay. And more biased towards technology funds like Nasdaq funds or broad-based US funds?
See, again, from a large cap perspective, if that 30% needs to have a more large cap character, then automatically
Hmm.
technology is going to be a large percentage of that.
Right. Okay.
But US also has stocks like, for instance, Walt Disney, Stanley Black and Decker, Estee
Hmm.
Lauder, which have
Yeah.
seen significant erosion over the last 2 years. The stocks are
Yeah.
down big time.
Right.
And these are companies which are, traditionally the old economy kind of stocks, which are not technology stocks,
Hmm. Hmm. Hmm.
but they are available at fantastic valuations. So
Okay.
I would, if so, I need to sit with the investor and see what kind of a mindset that investor has. So I wouldn't, paint with one brush that just go and invest 30% in the US.
Hmm. Hmm. Hmm.
We also have to look at what kind of a character the remaining 70% of his equity holding has.
Okay.
So I need to sit with the investor and make a comprehensive portfolio rather than, just saying go into US technology. US technology will be will be an important part for sure.
Hmm.
But how much percentage that needs to be, I think that needs to be decided when I sit with the investor.
Okay. Thank you.
All right, any more questions? Okay. Quickly check the chat box if there are any questions.
Doctor, you have a question from Rona Joy. Can you read that question? Do you want me to read it out?
In India, given the rate cut cycle has yet to begin, but the bond market has already rallied considerably. Would you expect equities to deliver higher returns than fixed income the next 3 years? Why or why not? Yeah, equities in the next 3 years will deliver equity returns, and that will be definitely be higher than fixed income. But one of the opportunities which investors have today from fixed income and the returns they could generate borders on what you could get from a large cap fund. So for example, if you're positioning a part of the portfolio through a tactical allocation into Government of India bonds, Government of India securities or gilts or gilt funds, which have a portfolio yield at this moment of around 7% or 7.10%. If you invest into that, once RBI starts cutting interest rates and that trigger happens, then there will be further fall in interest rates. That's not yet factored in completely by the market prices. So once interest rates fall, the market yields come down of the 10-year paper or the 40-year paper or the 30-year paper, there will be an element of capital gains, which will become part of your returns. So that will push your fixed income returns to around maybe 10% or 12%. It is that's the potential of fixed income at this point of time. So it may be say 10 to 12% once we get a couple of rate cuts from the RBI and bond prices move up and yields come down. So it could be 10 to 12% returns, which includes not only the portfolio yield of 7% or 7.25%, but also an additional capital gain of 2.5 to 3%. So that's the kind of returns you could expect from a tactical allocation to fixed income. But it would still be lower than what equity can deliver over the next 3 years. This low double digit is likely over the next 12 to 18 months. Whereas equity is taken over a 3-year time period. Large caps could give you something like a 12 to 15, 13 to 15%, and mid caps, if you're looking at the last 10, 15 years returns, is around 15 to 17%. And the 10 to 15-year track record for small caps is something like 13 to 14%. So the equity returns will be higher, but there is a tactical allocation opportunity at this point of time in fixed income. That's it.
There's a question from Mohammed Harris. He says, you mentioned investors should look out for stock-specific opportunities. Which sectors or companies would you suggest to focus?
Well, I am not or rather, we are not sector specialists, or we are not fund managers for that matter. But I can say that today it's the government spending largely on infrastructure, and there's largely on defense, largely on railways. So there's going to be a tailwind, especially in these sectors and companies which are allied towards this particular segment of the economy. Also, from an export perspective, if and Trump has already said that he's going to tax China, and Europe has already said that they're going to halt trade with China in certain segments. So that kind of presents an opportunity for India, and not just India. Of course, there will be other economies and other countries which will also try to play on that. But that does present an opportunity, a big opportunity for India. Just to give you an example, for instance, textiles. I mean, China is what, 50% of the world textile trade. India is 5%. If China has to go down from, say, 50 to 40%, that 10% gets allocated everywhere. And even if 2 or 3% of that comes to India, you're talking of something like a 50% jump in India's textile trade. Of course, there's a lot of things which Indian companies have to do to be able to, get there. But there are opportunities. And I can see that there are some Indian companies which are playing on that opportunity. Then travel and tourism. I mean, as India gets more affluent, there would be a large number of Indians who would be wanting to travel, not necessarily abroad, but within India. And we are already seeing a lot of traction, in hotels, hospitality services, etc. So again, those segments could be very interesting. Then companies like Swiggy, Zomato, which again, this is the traditional consumer business, but it's delivered in a different way. So, when I said there's a lot of interesting things which are happening in India today, and if we don't know which of these technology merging with the traditional demand could play out, but there are again very interesting opportunities in that segment as well. So these are some of the areas where we are seeing, at least I understand this space. That's why I'm talking about it. But technology per se is a very complicated space to be in. And I don't think I'm competent enough to understand technology or the kind of developments which are happening in India in the technology space. I mean, we are talking of semiconductor fabs opening up here, and talking of electronics, manufacturing, defense related whole lot of space related, a whole lot of stuff which is happening here. A competent fund manager should be able to identify these opportunities, value them appropriately. It's not just about identifying these opportunities. It's also important to value them appropriately, because end of the day, if you end up paying a huge value for this, then you also can face the downside risk to it. So, I mean, that's a long answer to a short question, but this is broadly what we see happening in India over the next 5 years.
So there was a question regarding the primary markets from Darshan. Was wanting to know how you expect the IPO scenario to play out in India in the next 2 years. There's been some hesitation among investors in the last couple of large IPOs.
So, I mean, if the idea or if the company is unique, if the company is so far what was happening is, any company which would IPO, investors would jump at it. I think that scenario will change. Going forward, investors will be more discernible in terms of what they apply for and what they get. So there will be definitely some moderation in terms of the IPO market going forward. But IPO market will continue because interesting ideas, interesting companies, companies like Swiggy, Zomato, this is something which is new, and these are companies which are growing very fast. They are going to need public funds. So these kind of companies will IPO.
Okay, any more questions, friends? Last 2 minutes, or else we'll conclude.
Okay. Thanks, Amit. Let's conclude.
No more questions. Thank you so much, friends. Thank you so much for joining us. Thank you, Parag sir. Thank you, Ashish sir. And
Thank you, everybody,
Thank
for
you,
joining
everyone.
us. Thank you.